This is what everyone does. This is what everyone's doing, and everyone's following this. I have a W-2 income. I'm going to take real estate. I'm going to make this real estate non-passive to short-term rental or reps. I'm going to merge them together and say tax.
Q&A, and it's exclusive to our amazing community of clients who are proactive, curious, and committed to building wealth the smart way. You brought the questions, and we are bringing you the strategic answers. We will get into those in just a second. Let me go ahead and share my screen before I forget. Okay, Assis, can you see my screen?
Yes.
Okay. If you have more questions that come to mind during this session, just drop them in the chat and we'll cover as many as we can at the end. But right now, we're just going to go ahead and get started. If you're new here, I'd love to introduce our speaker for tonight, Assis Acharya. Before we jump in, Assis is the CEO, founder, and lead CPA here at Investor Friendly CPA. He's the brain behind our entire ecosystem, including our outsourcing firm, full-time employee, our charitable arm, the IFC Hope Foundation, and our tax planning software, TaxMD, that will be launching very soon. Assis doesn't just talk tax strategy, he lives it as a real estate investor and business owner himself. He knows exactly what it takes to save money, stay compliant, and make smarter financial moves. He and our team of CPAs are here to help clients like you do the same. Today, he is here to break it all down and answer your questions live. I also wanted to touch on our generational wealth formula. It's a combination of hundreds of guides created featuring different tax strategies used by our CPAs, each paired with clear, actionable steps to help you better understand the CPA landscape and get the most out of your tax planning experience with us. Our clients receive these monthly guides that are relevant to real life financial situations. You may not use every guide or strategy right away, and that's completely fine. Think of them as tools in your back pocket for when different scenarios arise and you need them. Because the reality is your tax strategy shouldn't just stay the same every year. As your income grows, your investments evolve, and your financial goals shift, your strategy should evolve with them. These guides are designed to give you the right strategies at the right time, so you're always one step ahead. They're available as part of our client's tax planning package, but if you're not quite a client yet, then they are available for sale on our website. We've got a lot of exciting things in the works, new guides, new videos, and more resources coming your way. We don't want you to miss out on any of it, so make sure you're connected with us on social media. We share a lot of tips, tax news updates, deep dives into concepts, and you can get behind the scenes look into our virtual firm. Also, make sure you're signed up for a monthly newsletter on our website to stay up to date and access exclusive freebies. In our newsletter, we do include tax news updates, why it matters to you in a digestible way, key strategies, and direct links to our latest videos, blogs, and latest content. And as a thank you for attending and participating tonight, you'll receive a free guide after this session. We know some of what we're sharing tonight can feel a little overwhelming. That's exactly why we offer tax planning, so you can have one-on-one time with a dedicated CPA who walks you through your numbers, your goals, and your options to help you make the most of your tax outcome. At the same time, we understand that this level of support can be a bigger investment, which is exactly why we have developed this software mentioned earlier, which will give the opportunity to everyone to access these tax strategies we're talking about today and apply it to your own personal financial situations with the help of AI. This essentially makes tax planning more accessible and affordable, which is really exciting. We will give you the opportunity at the end to join the waitlist for that. And just a quick reminder, we also offer bookkeeping services to help keep everything organized throughout the year, so you're not trying to piece it all together at tax time. Now that we've covered those housekeeping items, let's get into some of the questions we've received so far this month from you guys. Assis, I will let you take it away from here.
Hey, perfect. Thank you, Kenzie. So this is our first question. Out of so many questions we get, we try to keep one or two questions which applies to most of the people. The first one says, we have our primary residence in California, but in March, we pursued our second home in Florida. I remember California is taxable, in that state level, Florida is not. and it matters. Planning on moving to Florida later this year and make Florida home our primary, and our current home, which is our second home, will be retiring from our company as well. So they're asking what are things we can consider. If you can ignore this in taxable and non-taxable state for a second, I would suggest you do this. So you can unshare the screen now, Kinsley. Let me explain how this works, okay? Two big impact from this is, first, how can you change the tax characteristic of your homes so you can benefit from both homes. Second is, when you both homes was and is going to be your primary residence, so how can you benefit from that Section 121, which is 2 years out of 5-year rule? What I'm trying to tell you, it's complicated. It has a moving parts, but if you understand the basic concept and can ask this question to your own tax advisor, this will be able to clarify, run the numbers and everything for you, okay? But here's the concept. If you're moving out of the one, it doesn't really matter which state, okay? If you're moving out of this one state, if you convert that to a rental property, do cost segregation, and then do a factor depreciation. Remember, primary residence converted to a rental property cannot take bonus depreciation, but they can still have a faster depreciation, meaning rather than 27 years, 39 years, you can take it in 5 years. I know this is a little more advanced topic if you do not know real estate, but I just want to make sure you understand this. The goal is to convert the first property that you're moving out as a rental property, legit rental property, so you can first take depreciation and offset your other income. That's the first step. And then you're going to move to this new property. However, you have to really plan this correctly and change your narrative with the IRS. If you're going to buy a property in Florida, which is a very touristy state, and your intention since the beginning is, I'm buying a short-term rental or I'm buying a rental property, you rent out, even if you're moving out, and take a full cost segregation depreciation, and later your life changes, your job changes, and you're going to move to Florida, then not only did a cost segregation on your rental property, which you eventually going to move in, you already got all the rental business benefit, and then you move in your primary residence. That's the best case scenario. However, this is risky, meaning you cannot have intention. You email your CPA, you email your friend, you announce everywhere, I'm going to buy a primary residence in Florida, and then try to take depreciation. Your intention, remember, okay, this is how IRS looks at your intention. So when you're emailing your lender, you're emailing your agent or CPAs, your intention needs to be documented. Hey, I'm buying a rental property in Florida. I have no plan. Don't talk about being primary residence. Your situation can always change. You can always convert it to primary residence, but don't have the intentions at the beginning. Why is that important? Let me just put this together. The first piece. Your existing home you're living, you're going to change that rental property, you're going to do cost segregation, you're going to benefit to offset your income and save thousands of dollars in taxes. The new property you're buying, your intention is rental property because you live in California. You are doing cost segregation and everything. So you're doing cost segregation on both the properties, benefiting from both. You move out of this, you go to Florida. So when you move into this new property, which was rental, now it's primary residence, you don't lose benefit. You don't have recapture anything. You just continue as primary residence. This property you just moved out into cost segregation also gave you benefit. That's the first piece about cost segregation. Now, second piece is this Section 121, meaning how can you benefit from Section 121 from both properties, meaning you not only avoid $500,000 appreciation in California home and $500,000 appreciation on Florida home. For California home, you have 3 years to sell the property after you move out. You can sell it to your own corporation if you really don't want to lose the control. It's an advanced strategy, so I'm not going to go too much detail into that. But if the property is cash flowing, you have a low interest rate, you don't want to lose out this on cash flow, you can still rent out, but you have to sell this within 3 years of moving out to a third party, or if you want to keep the property, you sell it to your own privately held corporation. So you can still control the rent and everything. That's on your old property moved out. On the new property, live in for 2 years at least. And then later when you sell it, your $500,000 appreciation is saved. So I'm going to back up and then repeat what I said, because you can see this is what I was telling you. There are a lot of moving pieces. There are two big tax benefits: cost segregation and not paying $1 million capital gain, a total of $1 million, combining both properties as a married taxpayer, and not paying tax on $1 million appreciation for two properties. If you plan it correctly, not only benefit from cost segregation, not only keep the property, and then also avoid a capital gain on $1 million gain. You can see this gets complicated. So talk to your advisor. So if you understand this, you can ask your advisor, how can I benefit from the both situation? It's that simple. So I'm going to stop. You're going to send this to you. You can rewatch this. Or if you have questions, please ask Kensley or me. We have emails. Kensley, for this topic, we have a guide called Selling Your Companies to Your Corporate S-Corp, send these guys to all the attendees we have, because that will really help them understand what we're talking about with numbers and everything. Okay, I'll stop now. I know it's complicated. Let's move on to the next one. You gonna share?
Okay. Can you see it?
Okay, the next question is, we are organizing to invest with our son as he flips the house. Family transaction, always trouble, but let's see how we can make this most tax efficient. He has years of experience working for others' businesses. I don't know how to set this up to be advantageous for tax-wise for both and equitable for both. Very important. Equitable is probably a more important topic in family relationship when you do business together rather than tax, to be honest with you, because it falls apart really quick if one party feels like the other party is not pulling their weight or other party is getting more advantage. Okay. So we have discussed option for live and flip. The question is, if we bought it and then did lease to our son and his family, and they lived in it for 2 years and then sold it, would that not be taxable because of 2 year of a primary residence role? We chose this question because it does relate to what we're discussing on the first question. Because you can see the first question was quite complicated. I'll answer this easily. If you buy and then lease to someone else, it will never be a primary residence. So you can never use that 2 year primary residence rule. If you have very strong relationship, look, there's the technical way to do this correctly. There's tax way. There's a lot of ways to do this. Most tax efficient way without complicating is this. The son buys a house in his name, he lives in it, he remodels it, and he sells after 2 years. That will avoid any gain. That's $500,000 gain, right? You can have your side transaction as a family and divide the money once the money is received. Most easiest and tax efficient without finding extra tax returns and stuff. Because the other way I'm going to tell you is going to be a little more complicated. What you suggested is not going to work. Meaning, as soon as you buy it, it becomes your rental property. You can benefit from in rental property depreciation, cost of years, and everything, but you can never benefit from that section 121, which is 2 year out of 5 year rule. So what you ask is no go. What I'm saying is the two ways. First was the simplest way. You do a side back end transaction with your family and benefit that way. Your son buys it, lives and flips, avoids taxes, whatever gain you guys have together, you can share it. When he buys a property, you can gift him a down payment. You can sign a loan for him. Right? You are part of the transaction, but not in a legal sense. He owns the property. Now, the second way is, and this is what I suggest, to be honest with you. Okay, because if the gain is more, like I said, it has to be equitable. And if someone starts doing all the work and they start saying you have done nothing while you're taking the money, it gets worse. So come up with the partnership agreement, create a partnership, meaning you put half, your son puts half, it becomes rental property. And then it becomes rental property, you flip, you sell the house, you get the profit. When the profit, there are other ways to avoid taxes. It doesn't have to be live and flip. Live and flip is one of the slowest way to scale a real estate business. We wait 2 years to sell this property. 2 years. We can show you ways we can buy in one property and flip it within a month, get all your money back, zero taxable, and buy 10 properties like that in a year and make $1 million versus waiting on one property for a live and flip. Second way is a more technical and right way, in which legalizes everything, and so you guys don't ruin a relationship because it's written down, it's partnership, and you do your own profit. So that is the right way. Easiest way is the other one, but it's also slowest. And I can tell you, if you go with the easiest way, this is probably not the only one property you're going to do it. Meaning, you buy this property, your son buys it, you try to do side goals, right? But while doing so, if he's really good at this as experience, you guys are going to buy another property. Now you can do 2 live and flip. And live and flip can only be redone every 2 years. So you're going to have to create a partnership for another property anyway, another venture anyway. So why really bog down with this one property? Just compile this into one really business style, legalize it, and do it on there. But if you're going to only do one this property and move on, then do the easiest scenario. And I just gave you have it on 100% owned by your son. So this is easy, but you have to really think what you want to go, and a lot of other factors: legal, family relationship, and then speed of stability. All of those things needs to be thought before you can actually make a decision. There was a second question. We'll see if we have any other questions here we can answer, because these are only 2 questions we can answer today. But we have other few questions in the Q&A and chat. We'll answer those. Kinsley, let's move on to the next few slides and we'll answer some questions, okay?
So the next slide, we're circling back to talking about TaxMD.
Okay.
So as we mentioned before, we have developed a software that will make tax planning much more affordable and accessible. So if you run into scenarios like the ones that we just talked about, this software will help you be able to answer the questions yourself, and you'll be able to see those tax savings within the software yourself. It's launching this year, so be sure to join the wait list. We'll also send this link in the email after if you miss this QR code, but I'll leave it on for just a second. But yeah, please join the wait list for the sneak peeks that we'll be dropping and for other free resources coming out with TaxMD.
Okay, let me explain TaxMD really quick so you guys understand this and why it is so important. You guys saw what I answered for the last two portions, right? You saw it's complicated. And I'm not gonna lie, I do this day in, day out. And when I answer these questions, when I'm speaking, I feel bad for people because it's so complicated. I can keep on going because I know the rules. But if I have to put this in writing and give it to you and to do this, do that, I have to email you. I'll give you some PDF and you can still not implement it. You don't know in your tax bracket how it saves you taxes. It's almost impossible. Most CPAs, even the best ones, struggle with delivering tax planning. Even us, we specialize in tax planning. We're proud of that. And you can look at our reviews. We do amazing job at that. But still, our delivery lacks and it doesn't meet the standard I want to achieve. TaxMD feels your need of one thing is you can literally go and say, I'm selling my property, I'm buying my property, and what is the best way? And it will show you tax impact of exactly what happens in your taxes to the dollar amount. It's not random. It's not a chat GPT. If your tax bracket is at 25%, this is what's going to happen. Second thing is this. We charge people $5,000 for tax planning. Like I said, I sometimes feel not proud of myself for doing a subpar work. This changes that. This is a very powerful tool. It's so comprehensive. Entity structuring, everything is here. So it doesn't hurt you guys to join a waitlist. We'll send you an email. If you're an early tester, get a discount and stuff, whatever you want, the deals, do it. You'll see what I'm talking about. We have a couple of months left before you guys can see this. Okay, let's move on. And I just want to tell people this because I'm excited.
Another question I sent you in the chat, though, is one that comes up often. If you want to address it, we don't have it in the slideshow.
Okay. So one of the questions we got is, hey, I have a property and I'm operating as STR for the first year. It was operational since May of 2025. And timeline is important because remember, it's 2026 right now. It's May. It's been a year. It's May for its last year tax return. And I'm learning about tax cost segregation and everything. Asking it, do you have any recommendation? What companies should I be using for cost segregation and timeline? So you need to understand this. The simple answer is there are thousands of cost segregation companies. There are online tools you can use. What I suggest depends on the value of property. If you have $300,000 property, do a DIY online tool. If you have $1 million property, maybe it's worth hiring someone who's going to charge you $2,000. So if you're saving $100,000. So out of what? But I want to know the risk of DIY cost segregation versus using a professional. And cost segregation, people are going to hate me for this, but the risk is very small. I mean, let me explain this, okay? If you have small properties, you have to understand this. Cost segregation basically takes your property and strips it. Let's say we have a $25,000 of furniture. The DIY tool says you have $25,000 worth of furniture, you can bonus depreciate. The professional firms comes and does the same study and tells you have 23,000. The difference is 2,000, right? So if IRS comes back and say, hey, you did not do with a professional, they're going to do it and they come up with the same 23, the difference is 2,000. $2,000 in your tax savings, the tax impact, 2,000 times your tax rate, which is at 20%, we don't have $400 of difference in tax impact that happened. So that's the risk. So are you going to pay? Some people charge $3,500 for cost segregation. You can do online for $700, to be honest with you. So again, this is not a legal tax advice here. We use your best judgment when trying to do the cost segregation using company. If you email us, we'll recommend which we trust. We have a range of people from 5,000, we'll charge you $700. If you just email Kensley or I or one of the emails we can share, we'll recommend you. Second thing is, when should we be doing cost segregation? So everyone on this call needs to understand this. If you bought a property last year, you have until you file a tax return. It could be 3 years from now. You have until then you can do cost segregation and report that in your tax return. So you're not late for last year. If you bought the property is operational, we can do cost segregation until you file tax return. It doesn't have to be April. It doesn't have to be in October. You happen to file a tax return after 3 years. You can still do cost segregation in 2 years and report it. Or I have another question which is pretty long and complicated, but they're asking, hey, I bought this property 3 years ago, so I do cost segregation. I'm not going to answer that in detail, but you can still do cost segregation this year to benefit from the 3-year-old property, but it has to be reported correctly and timely file return with 3115 form. Okay. Again, don't have to remember this, but the answer is you can retroactively go and get all the benefit from the property you might have not done correctly in the first 10 years ago. You can catch up and we can help you with that. The ROI, you can look at this. We have said $100,000 by going back, and there are people are paying $3,000 to file that form. So it's worth it. Talk to your advisors, see if they can help you.
And about cost seg that I see a lot is, when is it worth it? What is the break-even point?
Look, $100,000 property, which is rare to find nowadays, I understand, but it's very simple. $100,000 property gives you $20,000 reduction through cost segregation. $20,000 deduction is not tax savings. If your tax bracket is, let's say, 40%, top of the top, then you save $8,000 in taxes. If someone charges you $1,000 to do cost segregation, you're saving $8,000. You have 8 times the return of the money. There's no stock market or anything that gives you that. So that's how you make the decision. On our tax planning, tax MD will give you all this detail, so you can make an informed decision going forward. But if you're not sure, go on a free consultation with us. We'll detail run a number on a free consultation for you. We don't even charge people for that. So we can figure out a bit. The answer is, I know you guys are going to hate this, but it depends on your tax bracket. I said 40%, but what if your tax bracket is 10%? Then your deduction is 20,000, your tax bracket is 10%. That's in a $2,000 tax savings, and people are charging you $2,000 on cost segregation. Then literally you just spend money to not really save anything. So should you do cost segregation at that point? You have to make those decisions like that. Okay. For another question we have, I'm going to read that instantly, and we're going to answer this. Unless you have anything else to say before I read this long question and answer this for everyone.
No, I'll have questions on that. That's a good question, though.
Okay. So the question, I'm going to read this out loud and see, this first time I'm reading this too, so I have to really process this. I'm trying to determine the chances of qualifying with reps while having a full-time remote W-2 position. I work roughly 10 to 20 hours a week in my W-2. It is technically classified as full-time, but the actual hours worked are nowhere near 40 hours a week. This year, I'll work on more BRRRR properties than my W-2 time. The main question I'm trying to answer is if IRS will pin a default 40 to 50 hours of my full-time W-2, or if they will respect my actual hours worked if it's well documented. I am familiar with alternative studies like STR and spouse qualification and not able to pursue those paths. Okay, I'll give you a bad answer and a good answer, and then how you should be thinking to scale. I hope everyone knows what the BRRRR is. I hope everyone knows about the STR loophole. I hope everyone knows about the rep status. Okay, that's background knowledge. But I will give you very quick rep status. Remember this. For you guys to understand what this question is, you need to understand how to qualify for reps. You basically have to work. If you do anything, business or a full-time job, you have to work as much and 1 hour more. So 50% of what you spend on personal services needs to be in real estate, 50% or more. Meaning if you work 2,000 hours for the entire year, 1,000 hours needs to be W-2 and 1,001 hours needs to be real estate. So people who actually work part-time, 1,000 hours, and they work in real estate for 1,500 hours, 200 hours, they qualify as reps, contractors, and all those things, right? I'm talking about W-2 employee. People who do full-time real estate, agent, flipper, stuff, they always qualify, right? They only do rental, robbers, they qualify if they meet all the rules. But having W-2 is one of the most abused and most audited things. So what are you asking? Will IRS respect 40 hours a week? I'll tell you something. This is actual court cases. You can go and Google this and read about this. They will call your employer in a court. And then he's saying he's only working 10 hours and people are getting fired because of that. Because that's a problem, right? Because a lot of IT people, what they do is they say, I'm only working 10 hours. Maybe I'm getting paid 40 hours. And then I'm doing reps. And they go to the court. Unknowingly and knowingly, they actually lost their employment because their employer was brought out in the court because they were fighting. Because this gets audited a lot if this goes to court and they are doing all this in your neighbors, your employer, your co-worker, they'll ask questions. And one of the basic is your employer said they hired you 40 hours a week. And you can claim you work 20 hours, but I'm going to ask your employer. And they'll bring your HR wherever it is, and they will ask, hey, is this true? And the HR is going to know he's supposed to work 40 hours. He's been saying he's working 40 hours, so I cannot really say he only worked 10 hours. That has happened before. Let's do that. Sorry to give you a bad news. I'm not saying this is going to happen every case. If you can really document it, it depends on agent too, to be honest with you. Agent says, you know what, why I trust you. Looks to your log, you're only working 10 hours and you're working 20 hours for real estate. Okay, you qualify reps. Maybe that happens too. I haven't seen that, but some reps, but they would do a checkbox. Again, this is a checkbox and audit, right? So 40 hours, so they are full-time W, 40 hours, have they worked 41 hours in real estate? It's that simple. Now, how should you be thinking is the more important point. This is a temporary fix. I want to tell you, as bad as this sounds, rep status is not a long-term strategy. For how long are you going to try to meet this 750 hours and then do this every single year? If you really want to focus on real estate in the long term, are you going to do short-term rental every single year for the next 20 years? Are you going to do rep status for every single year for the next 20 years? That's what beginners do, and I don't blame them. Okay, next 1, 2, 3 years, do it. Save $120,000 on taxes. That's life-changing money. I understand that. But What wealthy people do is what you need to follow. It's called reverse tax planning. Okay, so you can send this to them as a guide as well. We have written this down. So is this confusing? This is what everyone does. This is what everyone's doing, and everyone's following this. I have a W-2 income. I'm going to take real estate. I'm going to make this real estate non-passive to short-term rental or reps. I'm going to merge them together and save taxes. That's what everyone is doing. What you should be thinking is, I have real estate. I'm not going to go and try to do management and do everything and qualify as reps. I'm going to make it passive. I'm going to have property manager. I'm just going to be investor. I'm going to buy this property. It's going to cash flow. But what I'm going to do is I'm going to create other sources of passive income as well as the people, so that even without qualifying for real estate, professional or short-term rental, this real estate will offset my passive income. That's what rich people do. If you look at any rich people, no one is trying to go and qualify as rep status by going cleaning, managing the property. What they're doing is they're investing in real estate, generating passive losses through cost segregation with the qualifying as reps. And what they're doing is that generating passive income to other businesses, restaurants, vending machines, anything, side hustles, doesn't really matter. Making passive. And then without qualifying reps, they're paying zero taxes on this highest tax bracket, the passive income. That's what you should be thinking. You can combine both strategies. You can do one property, you can qualify as reps for one property, and other 10 properties, you don't have to qualify as reps or short-term rental. You can make it passive. So you can get the best of both worlds. But the long term, trying to meet this 20, 40 hours, trying to track everything as you get wealthy, it's not that important. I know what important is and how can you save taxes without doing any work and lifting your finger. And I'm saying this because we've seen our client progress into those buckets. They start with what everyone is doing. We coach them, and then they're sipping margaritas at the beach and saving the same amount of taxes without really managing the property. Okay, I know I said a lot of things. I'll stop. We have a bunch of other questions too. Look, you can see it gets very complicated and technical. And so answer 100 questions and bore everyone. And some of the questions are very specific to their needs. So it really doesn't benefit everyone.
I have one more question. I see a lot, and I know that people on here, if they're thinking about investing, they haven't invested yet, they might be wondering too, what is the best state tax-wise to invest in?
What's the best state tax-wise to invest in? Okay, this is a good one. We have a YouTube video on this one. This was a YouTube video from a few years ago when I looked younger and less stressed. You can watch that now on YouTube, but it's pretty simple. People think I'm going to go into non-taxable state, Florida, invest there and save taxes. It's not true. If you live in California and you go invest in Florida and then flip in Florida, whatever you do in Florida, you sell the property, you make $100,000 gain. Florida might not tax you there because it's not taxable state. California, you always have to pay tax in resident state. So if you live in taxable state and invest in anywhere else, doesn't really matter. There's no benefit from investing in any non-taxable state, or line of 10 of that. Now let's reverse that. If you live in non-taxable state like Florida and then go invest in California, New York, same scenario. California is always going to tax you because it's the in-state nexus rule. The income was sourced to California. You sold the property, you flipped the property, you made $1 million there. California is going to tax you there. You always have to report income in the state where you make it at the state level. So you always get taxed. So the only way to not pay taxes is if you live in that non-taxable state and you invest in non-taxable state, then you'll never pay state taxes. Federal, obviously, you have to always pay. So very simple, right? Taxable, non-taxable, or vice versa. Doesn't really matter. You're always going to pay tax at one level. If you live in non-taxable state and invest in non-taxable state, that's where you avoid state taxes. Now, what happens if you live in both taxable states? Which state tax do you pay? You pay the highest tax rate. It's that simple. You live in New York, you invest in California. Whichever states have higher tax, you pay tax, you get credit. Okay, it gets complicated, but just think you pay the highest tax of both states. That's all. Does that answer your question, Kensley?
Yeah, you're still paying tax either way.
Yeah. See, the only way you're not paying tax is reduce your taxable income. Doesn't matter which state you live in. And that's what the cost segregation, that's what the strategies we have. And that's where we're going to launch this software. It's going to have a really good amount of strategies that we can implement, document, and audit trail, and a lot of things. If you do that, then you'll not pay taxes. And we're not answering any other questions. See, I don't want to bore people out. We'll go through a few of the slides that we have, give you some information, and then we'll wrap this up. And again, feel free to email us any questions and we'll help you guys with any questions you have.
Okay, thanks again for joining us tonight. And we will be sending out an email after this with those guides that we talked about, the selling property to an S Corp guide and the reverse tax planning. We'll get those out to you guys and we will see you next time. You can scan this QR code to get in contact with us if you need to. We're here if you need us.
Thank you so much, Kensley. Thank you everyone for joining. Again, email us, we'll help you out, okay? I'm going to give this a few seconds and then we'll end this. Bye-bye, everyone.